Okay, so welcome to this episode of Accounts Fundamental, where we are going to be talking about recording transactions. So let's look at an example that we have over here. A company engaged in the following transactions: issued shares for 100 in cash, took out a 4-year bank loan of 30, bought equipment and machinery for 60, bought inventory for 50, sold all the inventory for 90, paid salaries of 20, and paid interest of 10. Now the question is, how would a company record this transaction in the balance sheet using the double entry method? Let's start off by looking at issuing shares for 100 in cash. What this means is that cash, which is a current asset, is going to increase by 100. At the same time, we have a common stock under the shareholders' equity, which is also increasing by 100, leaving us with a balance sheet that is balanced at 100 on both the asset side and liabilities and shareholders' equity side. How about taking out a 4-year bank loan of 30? What this means is that we have a non-current liability, which is the 4-year bank loan, which will increase by 30, and at the same time we are receiving cash, which increases our cash, which is a current asset, by 30 to 130, and we still have our balance sheet balancing at 130 for both the asset side and liabilities and shareholders equity side. Now, what happens when a company buys equipment for 60? What this means is that the cash will reduce, of course, by 60. From 130, we now have a reduced balance of 70. But at the same time, a non-current asset, which is the equipment, has increased by 60, and leaving us with a balance sheet balancing at 130 for both the asset side and the liabilities and shareholders side. What happens when we buy inventory for 50? What this means is, of course, buying inventory means cash is reducing by 50. So our cash has gone down from 70 to 20. Our cash balance has reduced from 70 to 20. And we have another current asset which is increasing by 50, which is inventory that has just come in, and leaving us with a balance sheet that is still balancing at 130. What happens when all the inventory has been sold for 90 in the same period? What that means, of course, first of all the inventory has gone out, so we are left with 0. Inventory has decreased to 0. We don't have any inventory in our store, but at the same time we have sold it all off for 90,000, which increases the cash balance to 110. And on the liabilities and shareholders equity, we have revenue which has increased to 90, but it costed us 50 to get that revenue, and we have a net profit of 40, which goes on the retained earnings, making a total shareholders equity to increase to be 140, giving the liabilities and shareholders equity side at 170, and when we add up the asset side, we also balancing at 170. Alright, so what happens when we pay salaries of 20? what happens when we pay salaries of 20? Of course, here paying salary using cash, meaning of course our cash is going down by 20, reducing cash from 110 to 90. At the same time, profits are reducing because we are paying out an expense by 20 also. So our retained earnings has reduced from 40 to 20, and because we paid salary of 20, that affects our shareholders' equity, which now decreases to 120 from 140 to 120, and we still have our balance sheet balancing at 150. And lastly, let's look at this last transaction. What happens when we pay interest of 10? Of course, paying interest using cash, therefore cash is reducing. Our cash has reduced from 90 to 80 now. And of course, our profits are also affected. It has reduced also from 20 to 10 because we paid an interest of 10. That affects our shareholders' equity balance, which has also reduced from 120 to 110, leaving our balance sheet to balance at 140 on both the asset side and liabilities and shareholders' equity side. And there we go. We have a mini small balance sheet, and we've also learned how transactions are recorded using the double entry system.